Good morning, everybody, and welcome to the North County Estate Planning Council's February meeting. We've been doing this work from home for nearly a year now, and the good news is the numbers are beginning to move in the right direction with vaccinations and um, with case numbers beginning to come down. So maybe, as Churchill said, this isn't the end, this isn't even the beginning of the end, but this is the end of the beginning. And hopefully, some point soon, we'll actually be able to do these things in person again. So fingers crossed on that. Um, my name is Ollie Ben. I'm the Director of Philanthropy and Social Impact for the Jewish Community Foundation. We believe that every individual has the power to make a difference and that together we can change the world. We offer a personalized concierge approach to philanthropy. And our goal here is really to help you enhance your client relationships. We want to help you feel like we are your outside charitable department. So we're here for you however you need. Speaking of which, um, one of the ways that we really help professional advisors enhance their own client relationships is through our Trusted Charitable Advisors program, which is a network of lawyers, accountants, CPAs, financial planners, wealth managers. And again, the goal is to help you enhance your client relationships. And the goal is to make you feel more comfortable to bring a whole suite of philanthropic conversations and tools to your clients. But really, it's all about the network. And the TCA network, as you can see on the screen, has a wide variety of fantastic local and national firm name recognition. And this network has been going on for several years now and doesn't just include multi practice firms, but lots of individual advisors, including Bill, have taken part in the TCA program and have become grads of the TCA program. And so it's a program not just for new professionals, but also for those with 10 or 20 years experience. This is not a 101 level course. So if you're interested in signing up for the TCA program, which is enrolling and beginning in just a few months' time, you can either reach out to Charlene, you can look at go to jcfsandiego.org/TCA, or you can also just type into the chat, I'm interested in TCA, and we will reach back out to you and get you, have a discussion with you about whether the TCA program is right for you. But we're very excited about that program, which starts soon. So we're here for you for a variety of needs in your advising of your clients and helping you enhance your client relationships. And one of the things that we do offer is independent management of philanthropic assets. So if your if your clients want to manage their own donor advised fund or you want to manage it for them, that's something that we offer as part of our sort of concierge practice of philanthropy. So with that, I will turn things over to Bill to take things from here.
Welcome, everybody. Good morning. Glad you could be here for the North County Estate Planning Council San Diego's February meeting. It'll be a barn burner of a presentation with Mark Morris. Very sophisticated, and if in the scheme of our tagline, from basic to complex to cutting edge, Mark lives in the cutting edge. So it'll be a great one, and more on Mark a little bit later. A few announcements. Certainly put down on your calendars our upcoming meetings, always the first Tuesday of the month. March 2nd, we have a fantastic panel with Paul Hines and the fabulous Paul Greenwood and others on elder financial abuse. A topic that, we all bump into as we go. And of course, Paul Greenwood is the former district attorney that dealt with this and since retired, but he's out consulting in this arena. April 6th, we have a great panel presentation with the leaders of our community foundations, Mark Stewart of the San Diego Foundation, Beth Sorrell of the Jewish Community Foundation, and Christy Wilson of the Rancho Santa Fe Foundation. You can certainly check my email meeting announcements for upcoming presentations after that. A couple other upcoming events just to mention. Rady Children's Hospital has their professional symposium, which has changed a bit this year, where they have separate webinars. The first was actually January 28th, but it continues through February 4th and February 11th. Definitely worth taking a look at. I think you can actually go back and watch the recording of the first one, but it's really led by Tom Rogerson, who's just a brilliant speaker on the combating the shirt sleeves in 3 generations reality. You would have gotten an email alert about that too from me probably a week or so or 2 weeks ago. Then February 8th and 9th, we have the STEP Orange County has its annual institute with a great group of speakers on great topics. You would also gotten an email about that. Definitely worth thinking about. Couple thoughts. We are certainly missing our great time at Fairbanks Ranch Country Club. I think we're all adapting to webinars and such, but everyone I talk to misses that camaraderie of getting together at Fairbanks Ranch or for lunches or breakfast or what have you. So sooner than later, we keep our fingers crossed. Definitely, as you register for the webinars, certainly check the box if you're interested in our trifectas that are led by Pete Tentler. They're a great opportunity to still continue to develop deeper relationships with our various members. Do go to our website, which is www.ncepc-sd.org. David Jacobs is doing a fantastic job and ever making it better with connections and information in there. So do take a look at that. We still have our hot topic ladies hard at work, Katie Swafford, Roberta Robinson, and Kristen Shepard. They're keeping a lookout on things, and actually they will be doing a joint presentation in May on 2021 and 2020 updates. Without any further ado, I want to introduce you to Leslie Klein and Brian Zambano of the San Diego Foundation, who are sponsors today. Leslie and Brian, take it away.
Thanks so much, Bill. Hi, I'm Brian Zambano, Vice President and Chief Development Officer at the San Diego Foundation. I just want to do a brief welcome. I know Ali has a nice video for us primed up, and then Leslie Klein will talk to you a little bit more about some of the specific ways that the San Diego Foundation not only supports the estate planning community, but all of San Diego. Just want to, echo what Bill said about missing everyone at Fairbanks Ranch. Personally, I remember accepting the job at the San Diego Foundation, but before I started, the 3 CEOs of the community foundations here in San Diego were presenting at NCEPC at Fairbanks Ranch, and that was my first introduction to not only your group, but community foundations, and it really struck me the amazing network Bill has built and you all have built, and the collaborative nature of our community foundations here in San Diego. So we're just thrilled to, for many reasons, sponsor this and continue to support your organization. We at the San Diego Foundation like to say is our mission to inspire enduring philanthropy to enable community solutions. One of the ways we do that is obviously all the great work we do with folks like yourselves and other advisors in the community. I'll let Leslie talk a little bit more about that. I know you know a lot about Leslie and have a lot of great relationships there too. But one of the most significant ways, and I'm sure you've all heard about it too, is the COVID-19 Community Response Fund. The pandemic hit, we quickly pivoted, collaborated not only with our community foundation colleagues, but corporations, donors throughout the community to make sure we got much needed philanthropic support out into the community to help those nonprofits who are on the front lines supporting our community. To date, we've raised more than $64 million for that fund, and we've granted out more than $55 million to more than 200 different nonprofits in San Diego. We wanted to make sure that we were supporting not only significant nonprofits that could make significant impact but that we were also supporting smaller nonprofits and nonprofits throughout the county. So everyone who was impacted by the pandemic was getting much needed support. That work continues. It continues in earnest, and we continue to not only raise but distribute funds there. We were thrilled recently to be one of the nonprofits selected by billionaire Mackenzie Scott to receive some of her transformational philanthropy, which has gone out and again to the community here. We also recently launched our Black Community Investment Fund to help Black San Diegans increase generational wealth through home ownership, entrepreneurship, education, and more. So we look forward to continuing all the great work with our programs, all our great partnership with you, and all of our great work with the San Diegans, the philanthropically minded San Diegans who really want to make impact with their giving. So thanks, Bill. Thanks, Mark, for letting us intro a little bit. And I now know Ali has a brief video on the San Diego Foundation, and then Leslie's going to tell you a little bit more about the specific work and a great example of how we support you and donors in San Diego. Thank you.
There is a rhythm to our community, a cadence. We are connected to this tempo, these patterns. Every day, we can choose to bring opportunity and positive change to this positive place. Because this pulse, this heartbeat, it binds us and reminds us that we are all connected. We want to see everyone flourish in this place we love. By providing equitable opportunities throughout our vibrant region, we can create resilient communities where our family, friends, and neighbors can thrive.
Good morning, everyone. I'm Leslie Klein, Director Gift Planning Advisor at the San Diego Foundation. And as Ali said, can you believe it? Here we are, another circle around the sun since we've last been together. And as Brian mentioned, we wish we were with you in person, calming down from the traffic, greeting each other over Fairbanks Ranch Country Club coffee, trying not to spill it, and settling in for another great North County Estate Planning Council presentation, this one by expert tax strategist Mark Morris. As Brian said, at the San Diego Foundation, we've been fortunate. Although working remotely, there's been nothing remote about our work during this COVID time. We've been super engaged with many San Diegans who have financial means of any amount and who found it in their hearts to help those in need. We wanted to highlight several donors who called to help with more than cash and securities, and how you, our professional advisor partners, contributed to this effort. First, Don's daughters. When Don was planning his estate with his attorney, he set up a charitable remainder trust with 2 commercial properties in industrial Los Angeles. Shortly before COVID, we learned that Don had died and had left the trust to an endowed donor advice fund at the San Diego Foundation for his 3 daughters to manage. With the real estate market risk of COVID, Don's attorney and the trustee worked hard to get the trust settled quickly, and were able to sell the properties this past summer for more than the date of death values, in excess of $4 million. Not all new fund advisors move as quickly onto the charitable scene, but Don's daughters are very motivated to make grants as soon as endowment earnings are available this quarter. Like other families, they have different interests and geographic distance. So we recommended that instead of one fund, The trust set up 3 separate endowment funds, one for each of the daughters to advise. To further commit to their family legacy, they each have invested in both our traditional endowment fund and our sustainable investment fund. We look forward to all the great work they'll be providing to the community. Now, I wanted to talk also about Mike's family. Mike is a longtime foundation donor and is passionate about giving to the many causes he learns about through the newspaper, radio, and TV. We hear from Mike probably weekly on causes he wants to send money to. To maximize his giving during COVID, he wanted to donate a $6 million commercial building. We worked with his CPA to structure the gift so he could make the most of the charitable deduction. It would be difficult to use the entire $6 million write-off from this very low basis asset. By using a blended gift of a charitable remainder trust and a current gift, Mike was able to replace some of the building's income and have more AGI to write off against. Mike needed a tax attorney too, because the general partnership ownership that owned the real estate was outdated. He needed to amend the partnership agreement so he could make the gift without incurring gift taxes. With this gift of real estate, he now has a $4 million donor advised fund and $2 million charitable remainder trust and much more money to donate. He decided this is the perfect time to include his children and grandchildren through Zoom to help him advise his funds. Without those professional advisors helping, we wouldn't have been able to accomplish this gift for Mike. Fred's legacy. Fred's donation of a $2 million plus multi-family residential property with zero basis from multiple exchanges is worth the challenge of donating a C Corp asset from a corporation that owns other properties. Fred set up the C Corp many years ago for his architecture business before personal corporations were available. Stay tuned. We've referred him to a real estate attorney and a high-level CPA to help him restructure his ownership so he can separate the asset from the rest of the corporation without incurring income or capital gains tax. It's the first donation of many in his plan, which includes a family legacy fund at the San Diego Foundation to receive a $17 million trust. He's an only child and is very dedicated to his family name continuing on. We'll let you know how it works out for Fred and this gift from the corporation. So thank you to North County Estate Planning Council Board and especially Bill, and to the Jewish Community Foundation, our friends, for making this possible. And especially thank you to all of you, our professional advisor partners, and all you're doing to help make a difference in San Diego, the place we love to call our home. Thank you.
Thank you, Leslie, Brian, and the San Diego Foundation. Really appreciate your sponsoring this presentation. Great video and nice stories as far as some successes at the foundation. Without any further ado, I want to move on to introducing our speaker today, Mark Morris, who's an attorney CPA with Levitt Zacks CPAs. Levitt Zacks is a great local firm, been around for many years. I remember coming down from Seattle for the NYU Annual Institute on Taxes and hanging out with Mr. Levitz and Mr. Zacks. So it was great to get, they just took me under their wing. So that was great fun. Mark is a very sophisticated estate planner and is perfect for continuing our webinar on planning for the $30 million estate. He's going to do a deeper dive into the basics, onto the complex, and finally into exotica. Mark has some very cutting edge planning opportunities that he will be sharing today. At Levitt Zacks, Mark is responsible for the research and planning sophisticated in federal and state tax matters. His experience includes research on a wide variety of issues with a heavy emphasis on estate planning for high net worth individuals and families, partnership taxation and accounting, mergers and acquisitions, planning for closely held businesses and their owners, property taxation, and the tax consequences of workouts and bankruptcy. Mark is the expert residing in Levitt Zacks. Mark's estate planning work encompasses complex transfer tax analysis, liquidity planning for closely held business owners, advice on various insurance arrangements, and proper structuring of wealth transfers to charitable organizations. Mark is definitely a go-to guy. Hold on to your hats. Mark has got a power pack presentation that he's going to lead, and Mark, take it from here.
Well, thank you for that introduction. It's a real pleasure to be able to address you, and good morning, everyone out there. So let's go ahead. As Bill mentioned, next slide. So we're going to be talking, doing a little bit of a deeper dive, and yeah, there's my mugshot and contact information. Nothing much to see there. Next slide. So here's the legal stuff. I mean, everything I say today can be taken with a little bit of grain of salt. I've done my homework. You'll have to do your own homework to verify whether or not the topics and the concepts presented will be a really good fit for your particular situation or your client situation. So there's the legal stuff for you, and the appropriate disclaimers. So moving along, we got a lot to go. I'm going to do a little bit of a deeper dive here. As Bill mentioned, we're primarily talking about taxable estates. You know, the 30 million to 150 is pretty an arbitrary figure that he wanted us to kind of focus on. And so this is actually a part 2 presentation. In a previous episode, part 1, Phil Sullivan and myself co-presented on that and went through a few different things. This would be a great situation if Phil were here with us today. So next slide. So the other morning, as I was preparing for this, as I sometimes do, I wake up in the morning with tax ideas, and this article that I read back about the time I got married to my beautiful wife back in 1977. I read this article, and I remembered it. And of course, she knows how quirky I am with tax issues, why I would remember back on this, but it really strikes a chord with our presentation today. It talks about the estate tax in terms of it being a voluntary tax. And in particular, the main quote of it is what I really reflected on. It was by a living legend at the time, James Kasner. Professor Kasner said this once when he was testifying before Congress. He said, in fact, we haven't got an estate tax. What we have, you pay an estate tax if you want to. If you don't want to, you don't have to. And in this article, there was a whole laundry list of different estate planning techniques. And I took it to heart, and a lot of those techniques are still techniques that we use today. Some have been jettisoned, and I've added some of my own. So anyway, it was just an interesting comment. We'll let you be the judge of whether or not if this comment of the estate tax being a voluntary tax or not is still a true statement or just a pipe dream. But we'll move on. Next slide. So the topics that we would like to go through today, first of all, I'm just going to do a real quick run through of some of the part 1 topics, and particularly in light of where we are here today in the current environment, that environment being low interest rates, political shifts, and we'll talk a little bit about the future of step-up planning and some other things. I thought I would be remiss if I didn't at least mention a couple coordinating issues with regard to Prop 19 that came in November in the property tax. You know, we get so focused on estate tax. I do want to weave in some income tax consequences, particularly a step up in basis planning, which is really a paradigm shift for estate planners to also consider the income tax aspect. But we can't forget about property tax once in a while, even though time is short. Originally, if Phil had been on here, we probably would have done a deeper dive on some formula clauses. last year there was an important case. I'm just going to mention those real briefly in passing. The Wandry to Nelson issues on formula clauses, still very viable if you do them the right way. So then I would like to spend a bit of time in doing a basis step-up planning and doing a deeper dive on that particular issue, a issue that's one of my passions and that I've spent quite a bit on that. We can move into, as Bill says, a little bit of exotica for some people. They've only been briefly exposed to it. If you haven't been exposed to BDITs and BDOTs, you should at least be aware that they're out there, what they are, why and how they work a little bit. And if I have any time left, and I'll intersperse a little bit with Q&A as we go along, want to leave a little bit of that toward the end. If we have time, I would like to get into another hot topic of trust planning, particularly I think I think it was Larry Parente, the last session. I think he did an introduction for his company, but he mentioned this FTB Proposal C. Maybe I'll get in a little bit toward the end, at least whet your appetite for the trust. We'll see where we go. So that's what we hope to accomplish. Next slide. Okay, so first, the part one overview. In a previous episode, we talked about a few things. Next slide. And so when Phil and I were first tasked with coming up with a sample of techniques to approach for the so-called taxable estates, and to approach that from a standpoint of going from basics to creatives and maybe some of the super creative or more exotic space, we started out with just making a laundry list of things. Previously we talked a little bit about annual gifting, the lifetime gift exclusion, the fact that the IRS has published and said there would be no clawback if you use those annual or lifetime exclusion amounts, and they later sunset, as you know, and at the end of 2025. And so a lot of estate planners had the use it or lose it attitude. We'll mention that briefly and as we go forward on where we are now. We also talked about arbitrage that can exist with making low interest rate loans right now. AFRs are still at historic lows. And then life insurance as an important component to your estate planning tools. People like me like to get all caught up in the 4-letter acronyms dealing with estate planning a lot of the time. And sometimes a good part of the solution could just be good old life insurance out there that will create the proper solution. So we need to be aware of other opportunities that we're part of a team approach to other concepts. Moving on to the more creative tools that we examined, mentioned zero out GRATs and cascading or rolling GRATs. And I think I may have even mentioned, maybe it's in the exotic, a little bit more on the long-term GRATs. We spent a lot of time last time on IDGITs, which I won't go over, but hopefully you're familiar with some of the advantages of those. The freeze, squeeze, and burn, we won't go back over that, but that was approached. We had a lot of great presentations about the philanthropic world, and one of those tools in there is the Charitable Lead Trust. This is the heyday in a low interest rate environment for Charitable Lead Trust. We've had a couple presentations to North County Estate Planning about CLTs, and just don't want to overlook that as a great tool in the right space. And then you can get even more exotic for other people more well-versed than I to talk about life insurance in more sophisticated uses of life insurance. Moving on. Next slide. Okay. So as mentioned last time, we also, as you advance in your estate planning regimen, sometimes a concept that we like to use is to balance so-called bet to live type of techniques with bet to die techniques. And in that connection, one of our favorites is just to have a so-called intentional defective grantor trust, or IDGIT, or and combine that, which is it's kind of a bet to live technique. Over time, you can build up significant wealth through the freeze, squeeze, and burn, and particularly tax burn. You transfer tremendous wealth for that particular tool. And you can balance that if you with self-canceling installment notes or private annuities. We talked a little bit about those. Those are bet to die techniques, and you can combine those really well with grantor trust. You can also, if you have, you can combine a self-canceling installment note with a GRAT, and do kind of a mortality hedge. Those were briefly mentioned last times. You can have CLTs based upon a term interest, or you can base them on a lifetime. If you base them on a person's life, then that can also be a sort of bet to die situation in appropriate situations. We don't want to short shrift our charitable component, but anyway, just mention that one in passing. Then another whole paradigm shift, as I mentioned, is to start integrating the income tax with the estate tax savings, and that it's, you know, it's a lot of estate planners over the years have been so focused on the estate tax savings, and we really need to integrate what the income tax, and that involves a lot of times basis step-up planning. We mentioned last time a little bit about doing swaps just with an advance notice before the grantor or grantor trust passes. You can swap out low basis assets for high basis assets. That's a very viable and well-regarded technique. You can associate with banking institutions to assist with that. Lending prospects to have sufficient cash sometimes facilitates that as well. Subchapter K, that's partnership taxation, another close love of mine to estate planning type of techniques. Paul Lee, who's lectured here to us many times, he gets into subchapter K techniques, and you can achieve some basis shifting with that. It's really very involved and it takes time to achieve, but it's another whole aspect. I won't spend time with that, but you know, if subchapter K, I'm sometimes want to say that grantor trust will probably be my hammer most of the time in my toolkit. Subchapter K techniques will probably be my screwdriver, but I try not to see everything as a nail or a screw. And like I say, you know, sometimes you just need a saw, and that might be life insurance, or you need a fresh coat of paint, and that might be some charitable techniques. So really, you need to try to achieve the entire package. We talked about toggling off grantor trust status and reimbursement clauses for the grantor trust. That sometimes becomes, we'll get into non-grantor trusts a little bit. We didn't have time to go over BDOTs and BDITs and 678 trusts. Hopefully we will today. So that was our brief overview. Next slide. And so further sophisticated planning going on. Some of the topics that we had is to mention that you could have certain types of CLTs where you backload them, sometimes called shark fins. I mentioned that long-term GRATs, that's a little more sophisticated. If you're interested in long-term GRAT techniques, I tried to throw up some number cruncher presentations in our last episode. I hope some of you understood that, but it's Attorney Barry is really kind of pioneered the idea of long-term GRATs and when those would be appropriate to consider. In liquidity planning, of course, you can get into very sophisticated life insurance ideas to provide for paying for a taxable estate, the estate tax. And then not to be overlooked is Gregan loans. Gregan loans may have already hit their zenith or high point previously. The case law is still there to approve them. My understanding is the service is looking at trying to do a present value approach to loans for the estate tax and not, and so the Gregan loans may in the near future not be as what they once were. You have to be prepared for battle if you want a Gregan loan. They are on the books and you can get them. We've successfully negotiated some very successful Gregan loans, saving clients millions and millions of dollars. But that's another part of liquidity planning for those that even know what they are. Not going to spend too much time on that. Okay, let's go to part 2. Next slide. Well, and again, part 1 is where we were before. We did some discovery. So where are we now with regard to the things that we talked about previously? And you know, well, where we are is we're probably sitting at home, sheltering from a pandemic. But where are we in terms of these techniques? Next slide. So where we are is we have a Biden administration, and President Biden has a plan that he proposed. Now, depending on what speech you heard, a lot of proposals were made as part of the Biden plan. Perhaps the amount, first of all, there's a proposal as part of the plan to eventually lower the exclusion amount, perhaps to 5 million. Perhaps it would even go down to 3.5 million where it was a few years ago. Perhaps it would be indexed, perhaps not. There's also a proposal that there would be a rate increase in the estate tax rate to 45% from the current 40% rate. And then a lot of talk has been mentioned lately about a potential step up repeal, which is the fresh start that people inherit a usually increased because assets appreciate, going to be a step down in the assets at the date of death, transfers from a decedent. We'll be spending some time on step up, but the initial question is, should we spend so much time on a step up if it's just going to be repealed? So where we also are is we have a Senate split, 50-50 in 2 different parties affiliated, with a tie vote going to the vice president. We have something called cloture, and which can stop a filibuster, this so-called Senate rule of 60 votes to stop a filibuster, which applies for many other laws. But then we have the exception to that, which is for budget reconciliation type of bills. So for tax increases, those generally can go through a budget reconciliation process whereby you only need the majority vote. So that's something to keep in mind as we are trying to prognosticate where some of this future tax increase legislation may go. Last year, we talked a lot about clawback, that there wasn't one per the IRS guidance and all that. And what we're talking about here is the lower exclusion amounts. You know, if you use the currently available exclusion amount, but it turns out to be a lower amount in a future year, will you be harmed by that? And you know, the IRS can say there's no clawback. But on the other hand, there's a lot of talk about, since President Biden, when he was campaigning, mentioned a lot about these possible 5 million or 3.5 million or something else, whether or not that would be retroactive. And there was a lot of, you know, I'm sure talking to a lot of people out there preaching to the choir, there was a lot of activity last year in trying to do gifts of various sorts to use up the available exclusion. But there may be some that were still in the sidelines and didn't entirely use it up. So there's, if there was as more time lapses, well, first of all, let's get rid of the step up repeal. I'm just going to tell you what my thought process is on that, and then we'll go back to the retroactivity issue. So I don't think the votes are there right now for a step up repeal. It's a very heavy lift. It's a huge change to go to a carryover basis. It's only happened twice in the history of the tax law, and both times it came back in shortly thereafter because it was really unworkable. Whether or not there really will be a step-up repeal, I think at best that could be way out into the maybe after the midterm elections, maybe toward the end of the Biden first term, maybe. But I don't see it in step up anytime soon, repeal that is. So, you know, if I have a octogenarian that's not in, it's in average health, maybe I could still do some step up repeal. If I have a nanogerian, somebody in their 90s that, you know, I would still be planning for step up situations to occur. So anyway, as more time elapses and goes on before we have a bill or something, it's less likely that there will be retroactivity in lowering that. So, you know, with that retroactivity, could it occur at January 1? Could it occur when President Biden took office, January 20th, or will it occur on the time that the bill is introduced? There's something to be said about due process notification and putting people on notice. So again, you know, my estimate is that it's probably going to be prospective, that we won't have retroactive activity. But then again, just going back a year ago, there was a lot of things that probably couldn't be projected into the future, even based upon what we know. So the previous call to action was, you know, use it or lose it. We're talking about the $11.7 million exclusion amount. Are we still in that mode? Are we still in that mode? I think we tend to be, at least here at the beginning, to really consider that if there is still additional exclusion to be used, I would probably be doing that this year and there in the beginning part of the year before any legislation is introduced. And then overlaid with everything, the AFRs are still at historic lows right now. The 75/20 rate is at 0.6% here currently. It's ticked up a little bit. If last year there were about 3 or 4 months where it was at 0.4, I think we hit the low water mark for at least the 75/20 rate. We still have historically low. I think it's just going to be climbing, maybe gradually over time, but I think we hit the low water mark, but it's still historically very, very low. And a lot of these techniques really reflect well on the low. I mentioned CLTs are great for low interest rates. GRATs are great for low interest rates. You know, your installment note to idiots are great ideas. There's a lot of great ideas in historically low AFR situations. Okay, let's move on. So given all these givens, what to do now? A lot of strategies are presented out there. I'm just going to blast through some of these so that we can get on to some other meat and potatoes type of things. But, you know, the strategies all are suggesting us, I hear things like be flexible, be nimble, ability to pivot. And that sounds like an exercise technique to me, but the concept is there. So one of the techniques out there is to make gifts with disclaimer planning, which allows you 9 months from the time of the gift, and you can kind of while a disclaimant cannot direct where the disclaimed property goes, to do a valid disclaimer, one can draft into the particular situation, trust, or what have you, so that if something's disclaimed, it goes one way versus another. So that could help with, particularly if you're very concerned about the lower amount of the exclusion or retroactivity, and you can wait and see, and I can buy you at least a 9-month window. There's something in the past that has been mentioned about Clayton Q-tips. Now, those are testamentary situations in which if one makes the Q-tip election for a marital trust, then that sends the assets in a certain way. But if you don't make the election, it sends it in another way. That concept has now been being explored under inter vivos or during lifetime Clayton Q-tips, making an inter vivos marital trust, and the ability to either make a partial Q-tip election or full Q-tip election, and if that Q-tip could send it a different way. And so that can be built in as trying to be nimble and planning depending on what, if you're really, really concerned about this retroactivity thing. Another thing is to stuff assets into perhaps an LLC and give partial interest of that LLC asset under a formula clause. And you could do the numerator of a fractional interest could be the donor's available exclusion at the time of the gift. And so if they do retroactivity, that just would self-adjust over the whole fair market value of the gifted asset. And as mentioned, you know, some important missing ingredients in the Nelson case when we come to formula clauses is to make sure that it's as the fair market value is as finally determined for gift tax purposes. Actually, it should say as finally determined for a gift or estate tax purposes. It's really 10 magic words that were missing from the Nelson case formula clause that really should be considered when you're doing a formula. So those are some considerations. Let's move on here, looking at the time. Next slide. So yeah, no, back to that slide. There we go. So I'm going to pause here for just real briefly. I'll take just 2 or 3 minutes. Are there any questions that you see out there, Bill, or anything that have to do with either the overview, the retroactivity thing, or the flexible? You know, as Yogi Berra said, you know, I'm probably just going to respond, I don't know. I don't know what it is. It's hard to make predictions, especially about the future. So, you know, who does know?
No, Mark,
is there
I
anything
think you actually covered the questions. Jeff Dunham had 2 good ones, but I think you addressed those.
Okay, great.
There is one question hanging out there is, when do you think the Biden tax plan might actually pass? Q2, wherever?
Well, okay, so I'm focused. That's a great question. So I'm focused mostly on the state tax changes, particularly. There are also in the part of the Biden plan does cover income tax, which is the increase in the corporate rates, maybe the capital gain rates, that type of thing. I think those income tax changes have a much more highly likelihood of that happening sooner rather than later. Maybe not so much right now when we're in a pandemic, trying to do stimulus and recovery. Having a tax increase might not be the most prudent thing economically to do, you know, depending. But if, you know, whose oxen is going to be gored, they'll probably go for, you know, those that make more money, obviously. But so I could see the corporate rates, possibly the income tax rates, maybe that happening sooner. But for anything estate tax, I think I would take a viewpoint after the midterms, at least, you know, before anything on that estate tax side is going to really, because the votes aren't there right now, and I don't think they may or may not be there after the midterm. So that's my prediction, but I don't know. I have no idea. So let's move on, and if there are more questions, let's get into some more of the meat and potatoes. Okay, so much to cover. I did want to just touch on Prop 19, a property tax, just real briefly here, coordinating with that. So in case you were asleep last November, Prop 19 passed. Next slide. So Prop 19, there's 2 parts of it. One has to do with over 55 individuals and their ability to successively transfer a base amount over on personal residences. That has an effective date back in April, but you know, here we are, February 2nd. You know, if Prop 19, a lot of people have their hair on fire right now trying to plan for Prop 19 because a new parent-child exclusion for property tax will be coming into effect, and that basically requires that there will be no more commercial or the other real property besides a personal residence exclusion for parent-child. And so that's a big one. Also, even on the resident situation, the child has to come in and make it their own personal residence for that to be effective. And there's a $1 million cap. That's the new law. So a lot's going on right now, and we're running up against time on the clock for February 15th has to be into the recorder's office. Does it actually need to be recorded? That's a big issue right now. There's something called legal delivery versus the actual recording. Recording is just simply a notice to all the world that legal delivery has occurred. But a lot of folks and a lot of us are relying on the concept, and I hope the assessor's office will be doing this. I think they will. Everybody, a lot of other folks I've talked to think they will, but if you get everything in there ready to be recorded, and you've delivered the deeds and the PCOR and the parent-child exemption affidavit, et cetera, and it's all ready to go. The fact that it actually gets recorded afterwards because they're all stacked up, well, that's the recorder's problem. Legal delivery actually did occur in the delivery of the deed and that type of thing. So that has to take place. That being said, February 16th or February 15th is a holiday. I think February and a Monday, the previous February, I think it's February 12th, is also Abraham Lincoln's birthday. So I think some of the assessor's office may be closed then. So then it backs up to February 11th, like we're running out of time. So anyway, not a lot of news to a lot of you out there that are doing this, but get those in there. So I just take from an estate planning viewpoint, how does this property tax interact? So I'm going to move pretty fast through this again. So let's say you have a QPERT, Qualified Personal Residence Trust, and you originally had a 5-year term, but you know, you got 2 years to run before the remainder interest moves over to the kids or a trust for the benefit of the kids, and you know, at that point, mom or dad, who's ever living in the home, gets to start paying rent on their residence over to the trust, that type of thing. So, but mom wants to continue living. So a lot of people are talking about maybe perhaps what we do is we terminate the QPERT altogether. When you terminate a QPERT, I mean, there are provisions in a QPERT that provide that on conversion, when it becomes no longer a personal residence, and there's a 24-month lag period before this happens, it could convert to a GRAT. And so, you know, if for example, the trustee sells the home to the children, it's no longer, it becomes a rental property maybe, and so it converts to a GRAT. So that's one concept that, you know, what to do with GRATs. Another concept that might be a little bit on the creative side here, but I think it would work, is a lot of people are not aware that a 35-year leasehold interest is considered to be the same thing and as the fee title interest in real property from a property tax standpoint. By the way, a 30-year leasehold interest is considered real property for 1031 purposes. So there is a sweet spot between those two, and I've used that before to do 1031 exchanges that weren't subject to property tax. But anyway, we also do, so this other option may be to convert the residence to a rental unit. Maybe mom gets the remaining 2-year, the leasehold interest is maybe 2 years plus a 35-year right to renew, and right to renew leases are counted. So anyway, that's getting a little more creative, exotic. I am not going to take Prop 19 questions right now. I just throwing it out there for your consideration. This other example B, also real life example recently, where we had a matriarch. If she passes away and she's got property, it's going to the kids, and it's not a residence that is going to be made by them, it will be reassessed, and as a result of property. So one is to maybe do a part sale, part gift to 4 separate idiots. In this case, we had 4 separate children. Each one of them wanted one of the properties. And there's a loss of step up in basis unless you do it with an idjit with a twist, which hopefully we'll get to in just a minute, which I call a digit. And the twist will allow for the step up in basis, hopefully. That's my opinion. You can have your own. And then the goal of that also is to, through the note payments coming back, where the property is basically partly gifted and partly sold, so there's a promissory note, you can adjust for the cash flow on the note. Principal and interest are ignored when you have a grantor trust. We talked about that last time. And so you can adjust for the cash flow. So mom gets back whatever she needs from that. And so she can preserve the rental income stream coming back to her. You can get the property tax base step up, and you get a step up in basis. So, mission accomplished, I think. And on that particular one, a little bit more complicated. And again, we got a big rush on to get it down. Next slide. I'm not going to even go into this one other than to state that there are existing techniques involving LLCs or partnerships that one can, at least part of, you can do it after February 15th and still accomplish one part of it. The step transaction doctrine is as part of the legislative history when Prop 58 and 193, upon which the current parent-child transfer was based. The legislative history said the step transaction doctrine shall not apply. So if you have a step transaction, if you have a series of steps involving a parent-child transfer to the next generation, and it involves some partnerships, but if that was part of the transaction or a series of the transactions, then usually you were home free. After the new Prop 19, I'm not so sure that prohibition against applying step transaction would apply. But so you may need to age some of these TIC or tenant in common relationships for a period of time before you reconstitute it back into another partnership. I'll let you read the slide, and if you're not familiar with that particular technique, it does work. But again, the rush is on to do at least part of it before February 15th, if you haven't been doing them already. That's it on Prop 19. Next slide. Yeah, questions? Yeah, me too. Next slide. Okay, formula clauses. I'll just simply mention this, that last year there was a Nelson case that came out, and it was a formula clause. It involved a situation in which there were gifts, the intended formula clause of a gift portion to a trust and a sale portion in exchange for a promissory note to the trust. And the tax court looked at what was drafted out, and what was drafted, they failed to say that the value of the note or the value of the gift was in this case, they said it was to be determined by an appraisal after the fact, and they did determine the amount of that was transferred via the appraisal. They didn't say pursuant to, as finally determined for estate and gift tax purposes. That was the missing language, and so the tax court seized on that and undid it. It did have implications there. There was an additional assessment, as typical of these type of situations. The tax court kind of split the baby as far as the overall valuation. They still got almost a 60% discount, which was, you can't hardly call that a loss, but they didn't get what they really wanted to, was to absolutely peg and remove all the gift tax aspects. But so formula clauses are alive and well. And maybe at a future time, somebody will go through the different cases, the Wandry, the Christensen, the McCord, and then Nelson, and whether or not you involve charity for the reallocation, all that type of stuff. We don't have time for that, but they are good type of things. And again, the magic language would be to, as finally determined for estate and gift tax purposes, they still seem to be very, very valuable type of clauses to have. That's all I'll say about that one. Moving on. I think we're getting into our, okay, before I get into my step up and basis type of discussion, you know, just to air a little bit of a term that I hear thrown around a lot out there called loopholes, okay? And, you know, when I was going through my LLM experience and law experience, I often, taking tax policy cases, there's another term out there that's called tax expenditures, okay? So a tax expenditure, when you have tax legislation, is basically if there's a deduction or something that's given in the Internal Revenue Code, you know, first of all, they start out with the premise that, you know, it all belongs to us, everything gross income, okay? And we'll give you some legislative grace, some exceptions with these deductions. But if the tax legislation achieves its intended consequence, then in my mind, that's not a loophole. It may be a tax expenditure, but it's certainly not a loophole. It achieved it. For example, 1031, they were intended to allow for rollovers of, you know, property to another investment. That's not a loophole. I mean, it's talked about a lot as being a loophole, but it is achieving exactly its intended consequences. Section 1202 stock, you know, 100% capital gain exclusion. If you meet the requirements, you get the prize. That's not a loophole per se in my vocabulary. Okay, that's a tax expenditure. Most of 1014, the step-up basis, is probably a tax expenditure. It's in the code. You meet the requirements, you get the step-up. But sometimes you run into situations where you get an unintended consequence from the literal language in the code and the unambiguous language right there. And there are plenty of examples, and I can go on and on about GITLITs. Some of you out there know that we were doing GITLITs well before GITLITs made its way to the Supreme Court. And it, you know, double basis step up for S corporations involving COD, you know, it was there in the code. But a lot of people didn't take advantage of it. US Supreme Court said, yep, that's the way you should read it. And then Congress legislated around it. That's the appropriate approach. So there's a lot of other situations. So, you know, some of our favorite estate planning techniques are actually probably unintended consequences, zero out grats. The fact that idiots, you know, here you got something that's not included in an estate for estate and gift tax purposes, but, you know, treated as being completely ignored on the income tax side as the assets belonging to the grantor. That was not intended when they came up with the grantor trust provisions originally. But does it exist? Yeah, it does. And so that's another example. And I just want to get that point home a little bit. When the tax legislation is ambiguous, then that's when you look at legislative history. What was the intent? And that can be a very informative thing. But courts are not supposed to be looking at legislative history when it's unambiguous. That's just the way it's written. Congress may not have intended it, but that's the way it is. And so you know, anyway, moving on. I'm going to talk to you about a real loophole here. Basis step up. Let's go on. Okay, so here's the seminal question. It's been bounced around many times in the past. You know, gross estate inclusion, that's required for a step up, right? Well, that is the question, okay? That is, the IRS has been inconsistent on answering that question, as a matter of fact, and for good reason, and particularly involving grantor trust. Let's go to the next slide. So this has been under, you know, an idea that's been bandied around, this so-called step up. Originally, I could go into the history, and I will not because I don't have time. Going back to the 1920s of the step up and basis planning, and comments by T.S. Adams to an economist at the time, and what the intent was, and blah, blah, blah. But It's very interesting. But originally, the IRS chief counsel at once upon a time came out with a memorandum involving a grantor trust and situation. They opined that, in that particular memo, that they thought, well, you have to have estate and tax inclusion to get a step up in basis. And so this particular trust didn't have that. I think they were wrong on that point. They didn't express any authority for coming up with their hunch. I mean, it's kind of we'll get into 1014B9, which does require state tax inclusion for certain types of trust transfers to get a step up in basis, but that's really a default provision. So then a little bit later in PLR, another national office position completely contradicted that, involved a non-resident alien who created a grantor trust. And they came out and said, well, you do get a step up in basis for this particular trust, even though because of the foreign status, none of the assets were included in a gross estate. And then that got everybody excited. And so the IRS, what says, what are we to do? So they took it under study at that particular time point, and it's been part of their priority guidance. I've been waiting for this priority guidance. I'm not sure they understand what the word priority meant. I mean, they're moving forward, as far as I'm concerned, with glacial speed and trying to come out with this. I've been waiting for about 5 years for them to come out with guidance on this particular topic, and it's been number one for the last several years. As of last November, they made it priority guidance, and that is what to do when a grantor passes away with the grantor trust assets. Do you get a step up in basis or not? And that's currently on their plan that they expect to get done by June 30th, but I've been waiting every June 30th since. I talk and called the IRS on this. I've been back to Washington DC to talk to them and help the national office on this very issue on a couple points. But they probably will come out with guidance on this. And if you really want to know what that guidance will be, as I predict it, you should read the article from Tax Notes, August 6, 2018. Austin Bramwell and Stephanie Vera in Tax Notes talked about what they think Treasury should do with that. I wrote a similar article that wasn't published about 2 years prior to that, and basically I agree with everything they say in there. So it's going to be a carryover basis, despite what a lot of other folks have written or opined upon in the past, that for a normal type of an IDGIT. Let's go to the next slide. I'll do a little bit deeper dive here, and then I'll take a few questions. So to find a step up in basis, you need to look at 1014B. Okay, so 1014A of the code says that transfers of property from a decedent shall get a fair market value as of the date of death, whether or not that's up, or down, step down. So, however, 1014B says, and the following shall include transfers from a decedent. Okay, so there's not, at one time there was some thought process of whether or not 1014B was an exclusive list, or whether you could fall within the penumbra of 1014A and not have anything in the list. There's a case out there that I found, and it's been there since 1971, called the Collins case, says, nope, 1014B is your exclusive list. In 2015, when I went back to the IRS to discuss these issues with them, they really weren't aware of the Collins case. So I made them aware of that. And they, 1014B is your exclusive list. So if you don't find a home in 1014B, you're not going to get a step up. So section 1014B1 is the one that people in my opinion, try to take a square peg and ram it through a circle hole and try to make 1014B1 fit with a grantor trust situation. I don't think it fits. That's my opinion. I think that's the majority opinion. There is a minority opinion. I respect these other folks, some really smart folks, but I don't think there's any there if you try to They try to force it through on 1014B1. How can you force it through on 1014B1? I mean, it got to be a bequest, a devise, an inheritance, or it's got to be acquired by the decedent's estate. I don't see that. It's not a bequest or devise because those take a will. It's not an intestate inheritance, okay, going out of the will, and it's certainly not a beneficiary bequest to the decedent's estate. It's something kind of a trust, and there's plenty of other 1014B issues involving trusts all through it. So Congress intended it to go through B1. They did a very poor job. I mean, part of the argument that is in some of those articles is it's so easy to do the swap, the low basis for the high basis swap with intentional defective grantor trust. It's so easy to do. You can do it, and you can get the step up in basis. And since it's so easy to do, then maybe you don't have to do it. Well, I think you do have to do that swap if you're going to do that, if you want to get the step up in basis for, I think that's just a tax policy argument. Again, there's no there, in my opinion, humble opinion, for that. And again, I agree with everything they say, and it's going to be a 1015B carryover basis for the normal IDGIT situation. So where are some of the other sections we could consider where you might be able to get a step up in basis? Well, you do an inter vivos transfer to trust with a revocation provision. Well, nice. That it will be an estate tax inclusion event. I'm going to hold off on 1014B3 because that's going to be the next page in our deeper dive. You can do some of these other things, general power appointment. Let's look at 1014B6, for example. The 1/2 community property interest of a surviving spouse is not included in anyone's estate, yet it gets a step up by legislative grace under 1014B6. That's kind of a clue that you don't have to have estate tax inclusion to get a step up in basis. 9 is our default provision that just global. You do have to get a step up. You do have to get estate tax inclusion to get your step up. And 10 is for Q-tips. There you go. Okay, next slide. So what about 1014B3? I mean, I tried to adjust the language a little bit, make it a little bit more readable. It says if you transfer something in trust that the decedent created, and that decedent either retained a life estate or the right to effect beneficial enjoyment of the income, okay? There's a right retained to direct the income at all times during the grantor's lifetime in making any change. I emphasize the word any change in the enjoyment thereof, using a power to alter, amend, or this. So what about, what about a fiduciary power retained to direct the income distributions among the class of beneficiaries or a single beneficiary limited by an ascertainable standard, an HEMS standard? And does that work? Yeah, it does. Actually, there's plenty of case law that works, that supports that thing. But if that does work, what do you call this? Well, if you discover it, you get to name it. So I call it the directed intentional grantor trust, or DIGIT. So next slide. So if you're looking at this area of body of the law, you do have to worry about estate tax inclusion whenever you're dealing with a power over beneficial enjoyment retained by a grantor. And there are provisions under 2036A2, section 2038, and 2511, which is 2511 deals with incomplete gifts. So that's the danger, Will Robinson provisions that maybe have gone a bridge too far. Maybe I've caused estate tax inclusion by trying to get this step up in basis. If you actually look at those type of provisions, there is a carve out. I mentioned that there are regulatory, I can go to the regs under 2511-4C, and it starts with the general rule. What's an incomplete gift when you have over beneficial enjoyment? And then it goes on and says, oh, but if you have an HEMS standard, then it's held in the right type of fiduciary role, that's not going to be an includable. It's not going to be, it doesn't say including estate, it's going to be a completed gift. So again, you can go through the language. The language in 2038 parallels beautifully with the 1014B3 type of thing. But here's the thing. Those carve outs are by judicial appointment going way, way back. And even though the language says any, it also says any in 2038. But there's this Latin phrase, when you're analyzing things under the gift tax and estate tax, you're supposed to read them in concert. That is not the case for income tax. That's why we have, again, that's why we have idiots. Subtitle A does not equal subtitle B. Subtitle A is the income tax code. Subtitle B is the transfer tax provisions of the code. There's great case law, plenty of it, that says, one, you don't have to read them in concert with each other. And again, that's why we have idiots in the first place. And so that's my provision, my position on this particular one. You do your own homework and you can decide. Next slide. Yeah, so there's one of my colleagues laughing at me. It says, does a retained power over beneficial enjoyment cause estate tax inclusion within HMS? What about the similar language I just mentioned? Does, basically comes down to, by carve out exception, any doesn't mean any because of case law on the transfer tax, the gift and estate issues. But just plain language, it means what it says and says what it means on the income tax side of things until a tax court judge wants to legislate by the bench, and then he could come in and say that, or somebody else, or they could change it by legislate, make the language absolutely clear. They haven't done that. Again, I've talked to all the powers that be in Washington, D.C. About this particular issue. I know and they tell me I'm not wrong, but they will not rule privately, and I'll probably get a PLR later this year when they do come out with guidance, and then everybody will know. Okay, next slide. BDITs and BDOTs. We're running close to the time. I think I'm gonna pause for any Q&A right now on the step up and basis. We may, I don't know if time-wise, if we may get to the BDOTs and BDOTs. My clock is running a little bit ahead time. I'm seeing about 8:50. Bill, how far where do we go to? We go all the way up to the hour in the next 10 minutes?
No, we can continue from 9 o'clock to 9:15.
Okay, great.
At this point, we see no questions on step up. So you're covering everything that we need. So carry on.
Okay. All right. So great. Now let's get into BDITs and BDOTs. This is a little more exotic, if that wasn't enough on idiots and digits. So let's continue on. Next slide. So BDITs and BDOTs are two varieties, close cousins of something we sometimes refer to as 678 trust. And sometimes we use the term BDOT to include both BDITs and BDOTs. Okay, so that's a mouthful. Let's back up a second. So a BDIT stands for a beneficiary defective inheritors trust, and a BDOT stands for a beneficiary deemed owners trust. And again, both are concerned with a situation in which somebody other than the grantor, in other words, the beneficiary, is the deemed owner for income tax purposes, not for other purposes, of the assets of that particular trust. Okay, so how do you get there? You have to turn on the 678 power to get there, to have the beneficiary be the deemed owner of that trust. When we use the term BDIT, it's primarily used for estate planning as a substitute for an installment sale to an IDIT. It's nominally funded, and it deals with a right to turn on the power. We have to deal with a right to withdraw the corpus or the principal of the trust Whereas when to get a B dot effective, we're dealing with the right to withdraw in certain types of income from the trust. But both of those mechanisms can turn on the 678 power, but they're close cousins, but they're slightly different in results. So, and some of these slides I borrowed heavily from Edwin Morrow, changed them a little bit for my purposes, but he's talked a lot about these over the years. I would be remiss if I didn't mention in the Beat It in the same language, Dick Oceans. For years and years, he used to lecture at NYU on the benefits of a Beat It and how they worked and all that type of stuff. So he's got a lot of things. Lately, Stacy Eastland has talked a lot about BDOTs and how they work, and written a lot in this area, as has Ed Morrow. So again, these are sophisticated techniques, but they can be very powerful in the right kind of context. So let's go on a little bit of where they work and how. Next slide. So they can assist with certain non-grantor trust issues, including, okay, so one of the issues in a non-grantor trust, okay, that you often run across, and all you professional fiduciaries out there have run into this one, I'm sure, where if you have a non-grantor trust, you have very compressed trust income tax rates. I mean, you know, at 12,000 something and change, you're at the maximum rate. Whereas an individual, you have to wait, you know, particularly if you're married filing jointly, you got to get up in the $300,000 to $400,000 range before you're in the maximum bracket. So very compressed trust income tax rates, and Congress purposely designed that for a purpose way back in the day. Thus, when you have a non-grantor trust and you have some beneficiaries, one could be sorely tempted to make a distribution to pass out D&I to the beneficiary at their lower income tax rate. On the other hand, the professional fiduciary or anybody wearing the fiduciary hat would be kind of remiss in maybe doing that, because asset protection reasons, we don't want the kid getting the funds too soon. I mean, there's a reason the trust was created, the overall purpose of the trust. And so maybe we don't want to do those distributions. Well, enter the BDIT or the BDOT situation. They can really help out in these situations. So you can dump out the distribution into a trust where the individual will be taxed at their particular rate, but they still don't get the access to the things. It's still in further trust for their benefit. So that's a really super great use of the BDOT, one of them. Also, the ability to transact directly from the beneficiary to the BDIT or the BDOT, and to do sales in exchange for installment notes, and the same things that we do with a grantor to a grantor trust all the time. The same rev rule applies, 85-13 applies in the BDOT type of transactions. And that super flexibility is really where you can get some really great advantages of doing that. So that's a basic understanding. Next slide. Okay. So basically, I'm going to have to blow through this pretty quickly. There's a couple examples of where BDITs have existed in certain types of frames. These type of two examples here would cause estate tax inclusion. That's not really attractive through the withdrawal power. So we'll bust through that to the next slide. But again, it's the right to revest the corpus. If you really look at this, and those of you who are familiar with ILITs, you'll see a lot of close similarities to it. In other words, you have a crummy withdrawal right to withdraw the lesser of 5,000 or 5% of the corpus. And a lot of times to set up the BDIT, basically all you do is you put $5,000 in, allow the period of time to lapse for the withdrawal. That turns on your 678 power, boom. Now you got a 678 trust, And that's one way to create it. There's plenty of private letter onlys around. You see some of those in the 2000s. I'll tell you, our firm got a PLR back in 1985, okay, for an up and coming wealth family. I think with that time we were working on getting from G2, generation 2 to generation 3, trying to figure out how to get a lot of wealth over there. We got a 1985 PLR that says, yeah, you got a perfectly fine beat it situation for that. You know, you really start out at only about, you know, $5,000, not much. There are ways to leverage and techniques to get more. Today, each one of those 3 678 trusts have well over $100 million each in those trusts. So powerful if you know what you're doing. Okay, next slide. Here's some typical steps, and I basically go through, here's how you would create a beat it and do everything to get that set up. But the problem is that you know, I won't call it chump change, but it's not very much. You start out with $5,000 in the trust. What can you do? You can sell 50,000, 10 times maybe. Of assets over it. That's just that's not going to get you started too far. Now you can, the I in this one is inheritors. You know, you can, this could be a proper recipient trust of inherited money, and that works great as far as getting, as opposed to giving it outright to a beneficiary, give it to their beat it. That works great. That's another way to get some good wealth going into these type of trusts. Next slide. Yeah, so it talks about some of the problems of doing that with the small and the BDITs. That's where the B dot comes in, where you can do significantly more in the funding if you want to go that route. Next slide, really. So this talks about the dilemma, the small corpus seed money gift, you know, the 5,000. So Dick Oceans used to always talk about one way to do it was get third-party guarantees and actually getting an appraisal on what the guarantee was and all that type of stuff. And maybe paying a guarantee fee. The solution I really like for this particular thing is if you have a well-funded IDGIT just sitting over there for the benefit of a particular beneficiary for which the same grantor may have created a BDIT for them, then that, and it's well-funded, it has its own net worth, that'd be a great guarantee, that would be a great entity to have the guarantee in that particular case, because it's already for the benefit of that beneficiary on the installment note that they get back from their selling assets to their own beat it. And at today's low AFRs, that's another way to build up wealth. So take, for example, currently what, February 0.12 for 3 years. Okay, 3-year short-term note. I only have to pay 0.12% to borrow money. So you get a well-heeled, you get grandma that's got plenty of money. She lends $10 million to the beat it in exchange for an AFR. And so, and maybe in 1 year makes 8%. So, you know, or maybe it's half a point. So, you know, you get 750,000, 800,000, something like that in just 1 year coming into just from the earnings off of the arbitrage off that note. Now you got a well-funded beat it. So it's got up to 700, maybe let's call it 700,000 that's there just from making a low AFR. Now the beneficiary can come in there and maybe sell something like $7 million worth of property to that well-funded beat it, and everything should be okay. So there are other techniques to, you know, even though you start out with pretty small things, their guarantees, etc. Ways to get around it. Okay, I'm bumping up against close to my hour. Let's see what else we got. Let me just mention something on BDOTs, and then I'll swing to the INGs and take questions. Okay, so the mechanics are there. Is it really, you know, you have to have the guarantee, you got to be, there's PLRs. Let's go to the next question, next slide. Okay, there's some more about doing the guarantees. I want to get to BDOTs. Next slide. Okay, so the BDOT is a right to, it's not to vest the income. And when we're talking about income and some of the slides that go through this, we're really talking about taxable income. A lot of times in subchapter J, you know, dealing with trust income taxation, you're talking about fiduciary accounting income from income versus principal. But when we're talking 678, we're talking about taxable income. And so to set up a BDOT correctly, it has to be the taxable income, which includes the capital gain income. And you have to define that in the trust. And if you do, there are PLRs that say, that's great, that right to withdraw the income. And then the lapse of a BDIT, you know, it's $5,000 in it for a BDIT, $5,000, it lapses, the corpus, grantor is done. And there's no more lapsing. With the BDOT, what you do is you lapse the taxable income every year, okay? And keeps the 678 power going. And that's the way that those are fashioned. Next slide. Yeah, so this talks about accounting versus principal and what kind of income we're, next slide. And more of the same of what kind of income we're talking about in a BDOT. So keep going. And there's some language and some more ideas about creating the 678 power in a BDOT and the income. Let's get to the next slide. It'll cite to you a PLR. I wanted you to see the PLR. So this PLR 2016-33021, very important PLR, I think, anyway, in which a non-grantor trust created a second trust that was a BDOT with respect to that trust, okay? Very creative thinking, got a PLR on it. A lot of people are exploring how far that can go. But it has a lot of uses. I've used it in a certain situation, came in really nifty. And so that's something to be thinking about in creative. Again, these are a little more exotic type of uses, but they're handy tools to have in your tool belt. Not for the totally risk adverse, but they are out there. So next. And here's an example of using a BDOT where you do a sell and actually they do some, in this particular case, the beneficiary does a near deathbed swap out of the assets, just like you could do with an IDGIT, and to get a step up in basis. There may be some other ways to angle that one. So other advantages. One more slide and then we'll take some Q&A. This is just contrasting BDITs and BDOTs, which I've already tried to rush through and compare and contrast what they are. Lots of PLRs out there on the, as I mentioned, we were able to get one way back in 1985, believe it or not. So they've been around for a while. Go ahead. yeah, more contrast and, you know, it's particularly when you come to the guarantees, how much should the guarantee be and all that. It's some of the finessing with BDITs. Go ahead. Inc Trust. Okay. I'm going to blast through this in 30 seconds. Next one. So Inc trusts are incomplete non-grantor trusts. They are designed as a state tax minimization technique. They can be very successful, particularly with exit strategies. And there are three types of hurdles to success. One is the income sourcing, and there's a nice Latin phrase there, the mobilia rule, which basically says that when you're dealing with a intangible, such as a stock, if you're going to sell stock, these work really, really well. All right. Asset sales, not as good, but you can still get some benefit on there. Because the asset sell, one of the intangibles is goodwill. There's some case law on that involving California. Won't get into the details, but you have to have the right kind of income. It has to be non-California source. In this case, if you're a California resident, and that can follow to wherever the trust is located. If the trust is located in Nevada, it's a NING. If it's located in South Dakota, or Wyoming or Delaware, some of the favorite places, you know, really powerful. The other fiduciary apportionment, the way that California at least approaches this whole thing, is they look at where the fiduciaries are located. We call this a cast of characters. There are certain types of fiduciaries, and then there are other people advising that may be wearing a fiduciary hat that normally you may not be thinking of, it that kind of can direct the fiduciary in some of these other jurisdictions. And so you have to be careful about that, but that's just proper drafting and refinements. There's some articles out there on how to do that well. Then there's something called beneficiary apportionment. Not all beneficiaries are created equal in California. You got your non-contingent beneficiaries, which means they're really not vested. Non-contingent means they are vested. There's no contingencies versus a contingent beneficiary. They're really not vested in their beneficial interest. It's to be decided by a distribution committee, whether or not you get a distribution, how much and when. And that type of beneficiary does not count for California purposes in apportioning the income back. And so you can have these large liquidity events in which you sell, do it through the trust, and basically California can't touch it. California does have its throwback rules. And so sometimes when you do get a distribution, if you're a beneficiary, they can tax both the DNI distribution and the previous income. So what is the FTB is basically thrown up their hands and said, we know these exist out there. We know they're working. We really don't have a great way to approach them right now. Please help us out, California legislature, and change our rules from fiduciary apportionment and beneficiary apportionment to something called where the grantor, we're gonna make it so it's a grantor trust for state income tax, game over. And that's the New York approach. And they want to do that. This proposed legislation will probably take effect January 1st, 2012. This bill, this proposal by the FTB doesn't even come up to the legislature until June of this year. So the big takeaway on this is if you have a liquidity event, you can do some great planning in 2021 this year to avoid the proposal C. There may be some workarounds proposal C, but I just wanted to plant that seed in there for the high net worth individuals, your serial entrepreneurs that may be selling interests. This has a lot of good opportunities in there for the properly advised. And so again, not for the risk adverse, but it does help out a lot. So with that, I appreciate your attention. Ran through a lot, I know, some of my favorites, and I will if there's any time remaining in 4 or 5 minutes, I will address a question.
Mark, thanks so very much. I mean, you were totally on top of a myriad of issues and opportunities for planning. Overwhelming, I know it going to take us back and walk through the PowerPoint presentation several times to kind of get further up to speed. I know certainly Mark is most available to help in some of the planning that you all have, so don't hesitate to catch up with him. We do have a question as far as how do you prepare your client with some of these techniques surrounding the expectations or a possibility of an audit?
Yeah, good question. So you, again, they're not for the risk adverse, but you simply have to document that you've explained these different things. You can explain a lot and write backup memoranda and explain everything. A lot of times at the end of the day, there has to be a trust factor. Sometimes the client will just say, well, if you were in my shoes, what would you do? But each client is different as to their particular risk tolerance. There are certain risks involved with on audit, and then there are certain risks with regard to future legislation. So the audit risk, we wouldn't, you take that position of where you would be in is from a standpoint of, we may win this at the examination level. We may win this at the appeals. You may not have the staying power, but if we have to litigate, we're pretty darn sure with a fair hearing by a judge, we could get this through a judge. That may not be what they want to hear, but that's, when we're dealing with substantial authority or more likely than not type of positions, you just have to have that discussion. And again, everybody has their own risk tolerance when it comes to this kind of stuff. I don't know if that helped out, but that's part of the communication is the key. Nobody likes surprises. And so you simply tell them what the state of the law is and where it isn't and where it could go. And you just have to deal with it.
You bet. And now, at what point do you recommend obtaining a PLR before proceeding?
So when there's a lot of dollars at stake, PLRs aren't what they used to be. I used to get several of them back in the day, but not so much as much now. You start out with I think it's about a $11,000 or $12,000 user fee. The IRS charges just to entertain the thought. But if there are significant dollars at stake on a particular issue, we go for it in getting a PLR when one can be obtained. As mentioned, right now the IRS is in a no rule position on the grantor trust basis step up issue. I think I know what the guidance will be when they do come out with that. Hopefully they will remove that taint. They will opine upon the 1014B1 issue and say that a normal IDGIT will not get a step up basis, but get a carryover basis. My discussions with them for the last several years have been that on the 1014B3 issue, they will not opine. They're just going to leave that blank, and that will be right for a PLR. I want to get that PLR. If they will rule on it, but they have to be able to not do that. In the meantime, you just have to do your homework.
You got it. Just one last question relative to ings, nings, dings, and what have you. Pre-proposal C, where is California at as far as chasing residents, who might have moved from out of California, and for dealing with transfer issues that are potentially subject to California tax?
Okay, so if you park your stock into the ning or ding or wing to the ing trust, and the liquidity event occurs, the sales proceeds are there, then if the California resident is still a contingent person and never receives a distribution, California really can't touch it. But a lot of times they want access to the money, they make the distribution. Bill, as you mentioned, they may move out of state. You need to be wary of the timing issues. with respect to moving out of state to get that distribution. And that's where a lot of the angle goes. But hopefully I addressed that question. Do you want to follow up on that at all, Bill? Was there another
Yeah,
thought
no,
there?
I think that's as far as we can go as far as our timing here. I think as
Yeah.
we discussed, there's probably a whole nother presentation that's going to dive further into the Ning Ding world, as well as just what do you do if you want to, or how far do you want to go to not be treated as a resident of California anyway. So that might be two good topics to combine and plan for in the future. But without any further ado, Mark, thank you so much for a fantastic presentation. It was power packed. Certainly for all the participants today, if you have questions, certainly reach out to me and I can round them up for Mark and we can get back to everybody, build our background information from there. And without any further ado, thank you, Mark, and Ollie, of course, who made it all happen. Charlene, who's right here, and Leslie and Brian. Thanks for a great webinar.
Thanks for the opportunity.
You bet. Thank you all.